Thanks for tuning in to Talking Point. I'm your host, Neeraj Shah. And after the battering that the Indian markets and the US markets took yesterday, it becomes even more important to marry the micro and the macro, considering the macro is so very much intertwined and overbearing on equities at large. Somebody who does that with aplomb and I would not use the term alarming, but with very interesting accuracy, Dhananjay Sinha. And he's been bearish for a while now, if I'm not wrong. And it'll be lovely to hear his views on how does he see the current situation. Dhananjay, great having you. Thanks so much for joining in.
Thank you, Neeraj. Yeah.
Dhananjay, the people, at times people look out for contrarian voices,
Right.
because it helps them try and understand if there is indeed a ray of hope in a bear market or a word of caution to be noticed in a bull market. Now, my question to you is this time to be contrarian, or does it make just plain simple sense to go with the flow?
So the thing is that, when we sort of started cautioning the market, I think it was about 6 to 8 months back. I think we came out with multiple themes across sectors also, especially with respect to metals, banking, investment cycle, etc. But we were also talking about multiple global inflection points where basically, which included the context or a hypothesis that we were expecting the liquidity to normalize. The pace at which the normalization is now happening is much faster. So it's happened a little later, but it's happening faster now. The second thing was that we were anticipating that the impetus that were there with respect to the global growth on Indian economy and Indian corporates, etc., that will start fading. I think it is beginning to fade, and we were also anticipating certain normalization in trade sort of volume growth. And fourth thing that we were talking about, I think it was in October, we were talking about stagflation. So I think multiple things that we were talking about is panning out. I think what is critical from in the last, I would say, 6 months or so, if you look at the benchmark indices in our country, it has come down by about 15% on a YTD basis, and on a year-on-year basis, we are actually flat or marginally negative. So essentially, what is happening is that the global factors, which includes very high inflation, and we are also seeing very high inflation in India as well. We are lagging behind, and RBI has scaled up the trajectory of inflation, and also the fact that there is a synchronous tightening in global liquidity led by the US and then permeating across multiple other countries, and also India is actually forced into that. So all those things are very relevant for the market. So I think what you are seeing today is a inching towards a capitulation where you are expecting or where you're seeing the liquidity part sort of fading and the risk-free rates are rising. And what we haven't seen yet is the earnings trajectory as far as expectations are concerned. So from India's benchmark index standpoint, so if you look at Nifty, I think the expectation on growth on earnings is still very robust. I think it's about 17-16% in the next 2 years, following a 40% growth in FY22. So I think this is a fairly steep ask as far as the forward expectations are concerned, especially in the context where we are sort of heading towards a global slowdown. We know that every institution is scaling down growth trajectory, and US Fed, for instance, actually scaled down the growth trajectory for the US by more than 100 basis points. So I think those things will sort of start reflecting on India growth expectation and also India earnings expectation. So I think from a market standpoint, I think it's going to be a challenging thing with respect to the macro context and also with respect to the micro context. I think these things are panning out. I would say that I would wait for an eventual capitulation before I would sort of recommend people to start getting brave.
So what is the sign of that capitulation? Is it the levels of the market, or is it a sign that inflation really kind of moves ahead with some ferocity? Would it be a macro factor or a micro factor?
So I think the way we are capturing sort of capitulation, essentially we draw from past capitulation. We're trying to look at what are the multi-asset variables that one can actually track, be it the the bond yield curve, the government bond curves across the world, in India as well. We're looking at inflation, how the commodity cycle pans out, how the volatility index pans out, what happens to the credit market, the CDS spreads, etc. So there are multiple things that we are sort of tracking, essentially gathering all of them together. So what we have done is to really look at the volatility in each of these indicators, and we have sort of benchmarked what is the level one should look at against each of these indicators, and look at a certain quantitative variability around it, and summarize all of them. So what we are, what we have sort of found out, this is about 2 weeks back, is that it is just about 35% in the entire adjustment that needs to happen ahead of a capitulation. So I think we are still a long way to go before that capitulation happens. So I think to answer your question directly, it's about, eventually it will reflect in the level, but there are multiple indicators that needs to be fulfilled before we say that we are actually around there. So I think that is where we are. So we are very objectively looking at a framework, and we are looking at the right value, right valuation, and then we will try to look at how we change our views, and whether we have found value in various stocks and which segments, etc.
So here's my question, Dhananjay.
Sure.
When you're talking about the valuation,
Yes.
whether it's EV/EBITDA, whether it's a simple metric like PE, what have you,
Right.
yeah, or a price to book in certain cases, that itself might undergo some changes as
Yes.
quarter 1, quarter 2, quarter 3 shape high, right?
Yes.
So what adjusted levels are you looking for? Traditionally, India trades at a premium to MSCI IEM any which ways because of the higher ROEs that we've enjoyed. So we're currently at what, circa 18 times? Would you reckon that if we go to 15 times, then that's a level that you would find it's capitulation, or is it slightly higher, or is it lower?
Right. So the thing is that in what we believe now is that we are having a structural shift as far as the valuation is concerned. So if you look at the last, I would say, last 7-8 years, what has happened is that you have had a negative, correlation with respect to the valuation, which is P ratio for the index, for instance, and the return ratio. So essentially, we had a scenario where there had been a moderation in the return ratios, and the valuations were inching up compared to the period prior to that. Let's say from 2000 to 2013 or 2012, you had a positive correlation, which is a natural thing to happen. So essentially, over the last 7 years, what has happened is that you had a prolonged period of excess liquidity, low risk, low risk-free rate, etc., which was buoying the valuation. So what we are saying is that we now need to go back to the earlier period of 2000 to 2013 or something, and then try to benchmark the valuations around it in terms of index, in terms of stocks, etc., across the world, across the universe. So essentially here, what we are saying is that on a trailing basis, we are currently around 20-21 times. And
what you're talking about PE.
Sorry, PE. Trading.
PE, okay.
So what we were getting as a pre-2013 average, it was about 18 times, and one standard deviation would take you to almost like 15 times. So essentially, 15 times is where the downside is with respect to valuation. So I'm not sure whether it will go there, but I think there is a considerable downside. The problem is that you will also have downgrades as far as earnings are concerned. So what we are basically looking at is 15 to 20% downgrade in the Nifty earnings for FY23 and FY24. And this is kind of a very contra view versus what the market expects. I think there is certain amount of moderation that is happening as far as the analyst expectations are concerned, but it's still very, very flat. It's still very high in terms of the robustness in earnings. So we have to really see how it pans out. General view is that it might come down by 10-odd%. My view is that it could be even higher, about let's say 15 to 20%. Because if you look at 2000, if you look at
2013.
So if you look at 2000, so let's say year 2009 to 2019, prior to the COVID, the average earnings growth is about 6.7% as far as Nifty is concerned, and that is equivalent to the real GDP growth. Now, if we are looking at a real GDP growth on a structural basis, about 4%, this is what I expect, then you can't have a 16-17% growth on top of a 40% growth that we have seen in 2022. So I think there is a considerable downside. And if you look at 2009 to 2019 period, every year analysts started with a 25% growth and scaled it down by average of 22%. So and between 2014 to 2000, I would say 17, the downgrades were as high as 25 to 30%. So I think it's a fair assumption to take that, to assume that there will be a downgrade which can be substantial. So you have a multiple risk on the valuation and the risk on earnings, and then you have the market risk premium. So the market risk premium could also go up with a narrowing of liquidity from a global standpoint. So all those things are happening simultaneously.
Okay. So two questions. First, if you read Chris Wood, who's talking about another, I mean, he's spoken about a 30% downside for the S&P 500, and I think it would correlate to another 10-12%, if you will, or thereabouts. Rupal Bhansali of Ariel says that the S&P could be in the zones of 2000s, right? So sub 3000, so to say. That's another 20% downside there. So if the global markets are in that bit of a tizzy, which could take them down so much, then the 15-20% for India could come as a natural consequence of following what the globe is doing, right?
Of course. Yeah, I think, as I just mentioned, I described what is our thesis with respect to earnings, multiples, and the market risk premium. So all these things put together will actually is feeding from the global context, actually.
Got it. And the second part of my question, therefore, is that if the globe and India are synchronously falling, right, would it be foolhardy for people to assume that every single time in the past when we touched those bear market lows and then had a very sharp pullback, can the same happen this time around, or would it be wrong to assume that that's the same way or the same pattern in which the market will behave? Because the market could go lower and then stay lower for a period of time, right?
So the way to really look at is that first we need to come to that point of capitulation. So we need to wait how to that level, to that extent, and then see how things are panning out. So in this progression, what typically one notes is that there is a sharp fall, and then the market sort of challenges that fall, and people get in, and there is another fall. So I think people will be lured into a sort of a sharp correction. They get in, and then there is another shock. So I think that there will be further volatility, as I would put it, as we progress forward. But I think what would happen, what would characterize that bottom, essentially would reflect from our various variables that we are tracking in our capitulation model. So essentially, in that capitulation model, one thing one is expecting is a crude which can actually come down very rapidly with a very sharp fall in global growth. For instance, if there is a global recession, especially in developed markets, you might actually see a collapse in crude prices as well. As of now, the inventory levels are tight, and it's still it's still a fairly controlled market, and the crude is still at 120 plus kind of a thing. But if you look at other contexts, if you look at the metal prices, for instance, have started to have corrected. If you look at it, steel has actually corrected by almost like 30% or something, 20-30%.
And you predicted this.
Sorry?
And you predicted this.
Yes, we were talking about this. So I think, look at all the metals space. So I think that part is happening. Eventually, when the capitulation happens, other commodity prices will also fall. You need to put into context the 2014, 2016 kind of a progression where initially the metal prices corrected, agriculture commodity prices corrected, and eventually the crude also fell from 110 to 65 or 60 levels. So one can look at something similar like that. And once that recession or a sort of a shock happens, the policy responses will also become different. So I would say that once that happens, one looks at value. So I'm sort of not predicting a scenario where it falls and remains there for a very long time. It might actually recover. I can't tell you how much it will bounce back, but that's the point. We will get value, because then we will try to understand again how the valuations and growth, etc., will pan out. But I think that's the point one should actually look at. So I think that's about 6 to 8 months down the line, actually.
Actually, that was going to be my final question. Actually, not the final question. The last question on this, and then maybe one question on portfolio strategy. But just one more question on this.
Yes.
So the contra argument is that, as you mentioned, some of the points, and then if indeed there is some resolution to the Russia-Ukraine conflict, or if supply chain snarls ease up because China meaningfully opens up, if it does, we don't know the answers to this. But if both of these events were to happen over the course of the next 3 months, Dhananjay,
yes,
would that provide the trigger for a reversal of sorts in sentiment and in levels?
Yes, of course. So the thing is, if there are a sort of resolution on Russia, Ukraine, there is a withdrawal, etc. I mean, that would happen when the cost of geopolitics on the economy becomes so intense that the two sides need to sort of come to a sort of a meeting ground, and there can be certain agreement, etc. I would say that would happen when the pain on the economy can become much more unbearable, becomes unbearable. So I think that can happen. As that happens, some of these stress can actually unwind, and possibly some of the supply chain issues that have been exaggerated or accentuated because of the conflict can ease, and some of the commodity prices can come off, crude can fall, all those things can happen. I think once that happens, I think one has to be nimble about it. The thing is, we'll have to wait about it. I just wanted to add one more thing, is that the other bit of the whenever that capitulation happens, as the commodity prices fall, the important thing to really understand is that it is unlikely to be a scenario where even after that the growth in earnings will be very, very robust, because you will have a sort of a deflation, and then what will happen is that your top line growth will actually become flatter, can become very flattish, and hence earnings also won't rise much. So if you look at 2014 to 2017, it was kind of a flat earnings as far as the Nifty is concerned. The way to play that is to really look at which sectors will actually benefit in that particular phase. So we have to have a nuanced view. Yeah.
What are those?
So yeah, so I mean that's what takes me to my strategy in terms of portfolio. Right. So,
yes.
So essentially, what will happen is that your cyclical sectors, so what is going to happen is cyclical sectors which are rate sensitive, etc., will get impacted right now. So, for instance, your industrials, cap goods, infra, etc., and also let's say the banking sector, these guys will be actually will get impacted very adversely, and also with the liquidity tightening, your mid cap and small cap in particular, whether we have been highlighting there is a bubble, will actually take a significant beating. Once the capitulation happens, what will happen is your top line growth kind of flattens out, and as a result of that, you might actually see the solvency risks actually emerging, because that's where that's the second leg of things, that the second derivative of the capitulation that will pan out, which means your NPA, etc., for the banking sector, or the paying capability of leverage sector, etc., can actually be difficult. So I think the banking sector can actually see a sort of rise in NPS once again. So that's what happens in a deflationary scenario. So metals, for instance, will not do well. Likewise, I would say that whether there will be private capex and all, we will have to see, because as you see volatility in the top line growth and hence the utilization, visibility and utilization of asset, those things will actually still be coming much later. So which means, what are the things which will actually do well? These are the guys, these are the sectors where the intensity of material consumption is going to be very high, and these are in the space of autos, for instance. So I would say, even if you look at current scenario, metal prices are correcting. Yeah. So there is a spillover effect of that. Let's say the supply chain issues also sort of eases out once the capitulation happens, or the growth comes down, and there is a sort of support from a policy standpoint. Again, the consumption stocks would actually do well. So I think we have to keep it very basic, actually. Look at how the current progression would happen, and how it will pan out after the capitulation or a kind of slowdown or recession, and then look at it. So I think in terms of visibility, it will be largely domestic consumption related stuff. Maybe eventually, because of the technology, application of technology will be high eventually as the capitulation in valuation happens there. Those are the sectors also that can actually do well. We'll see. Eventually, beyond that, I would say that we have to really look at, from a structural standpoint, which are the companies and stocks that have delivered return improvement over a long period of time, or delivered returns on a compounding basis over a long period of time. Those are the stocks you'll have to identify and keep it ready once the capitulation happens. There are multiple things one can actually do, and we have to be fairly strategic about how we pick up our portfolio.
Yeah, well, Dhananjay, maybe a couple of months from now, when we are closer to the capitulation phase, it'll be lovely to understand from you how you do the selection of these stocks, keeping in mind the various scenarios. It'll be a lovely conversation then. So look forward to that as well.
Yeah, sure, definitely.
Great. Thanks for today. Thanks for your time, and stay well.
Thank you very much.
And viewers, thanks for tuning into this edition of The Talking Point.